Welcome to Investment 360. In the hot seat this evening, Paul Hansen, Director of Retail Investments at Stanlib. Mr. Hansen, thank you for joining us this evening. You've been on leave, and I know looking back at the markets today must be somewhat daunting given the news flow that we're seeing. Obviously, it is leaning to the positive today, given Germany and the positive numbers out on that front, which must make you smile.
Absolutely. I think it's going in the right direction. We've had a good start to the year.
You never think it's not going in the right direction. I need to point that out.
Well, US has, the last 6 sessions, been up 5 out of 6, and even today it's turned from a negative to a small positive. And it makes sense because stock market's cheap right around the world, pretty much. And there's value. Interest rates remain low, going lower in certain countries like China and Brazil, possibly even in Europe. So we're also going to go to make money. Are you going to sit in money market and earn 0.0001% offshore, or are you going to equities? And reasonably similar here, not quite as bad.
Well, top 40 is 950 points off its all-time high, hit at around this time last year. Some people out there would say that the market is looking expensive given the uncertainty. That's not how you see things, is it?
Well, unless the analysts are wrong, because the analysts are forecasting, and I'm talking consensus, sure, forecasting a forward price to earnings ratio on the JSE of around about 10 and a bit, you know, which is well below the average of the last 20 odd years, or since the new South Africa started. And it's cheaper than the American, maybe not the European, but the American and a number of the other developed markets too. So, you know, the all-share index is not far from its record high, maybe 300 or 400 points. But remember, that happened in May 2008, so we're talking, you know, almost 4 years ago, and things have moved on. It's about time we hit another record high.
Well, the top 40 was what I was referring to.
Yeah, sure.
It hit its record high this time last year at about 30,197, I think is the number. In terms of valuations and taking a cue from what Paul is saying, looking at South African equities now as a grouping, where are we? Cheap, fair value, expensive?
I think we're just below fair value on our metrics. We're definitely not as expensive as we were this time last year. And we're sitting on a P of 14. We've had some good earnings come through, and the markets hasn't gone anywhere. And you know, the one thing is, I know it's a scary environment that we're in, but just as Paul mentions, where else are you going to put your money? And although a scary environment makes you itchy about getting into equities, the alternatives look a lot worse. And so sticking to good, solid companies that pay fairly good dividends, have a margin of safety. I'd much rather be in equities to a degree than any of the alternative asset classes.
How are you feeling about currencies at the moment? Earlier I was speaking to John Drzyk from Oliver Wyman internationally and asking him about the risk that currency wars potentially present to the global economy as a whole. Is it something that concerns you?
Yeah, I think more at the margin though. I don't think, you know, I don't think it's a major issue. I think it's an issue here and there. Obviously, the China issue has been around for a long time. You know, I think the dollar, interesting enough, with all the talk about the negative talk about the euro last year, it only lost 3.5% against the dollar over the calendar year. You know, and it's still higher than where it was when it came out against the dollar 12 or 13 years ago. It came out at about $1.18. It's $1.27 at the moment, which is interesting considering what's been going on and how strong the dollar's been, you know, for the last 6 or 7 months, from $1.46 to the euro to $1.27 in about 7 or 8 months. You know, so I think that you probably find, you know, that the euro, there's a lot of negativity already built into the euro, and it might drop a bit further, maybe to $1.25, but it might be quite close to the end of its fall also.
You want to add,
Paul, just when you're looking at your asset allocation and so on, do you spend a lot of time looking at the currencies and, you know, almost trying to trade them through the stocks that you're buying, or do you prefer just to look at the stocks that are going to, that you have a favorable view towards and go?
Well, I think the currencies, it's a very good point. The currencies make a huge difference. You know, there's no question about it. I mean, look at the rand, you know, down 18% against the dollar last year, and most of the emerging market currencies down dramatically. Yet the JSE was up, what, about 2%. So it looked okay in rand terms, but in dollar terms, it wasn't good. And no question, even with the developed market currencies, your currency plays a huge role in your returns, whether it's the Aussie dollar and their stock market converted into US dollars, the euro, the dollar, whatever it is, it's very important, yeah.
There is merit, though, in a government or policymakers trying to hold their currency at weaker levels against other exchange rates at this period in order to boost exports. I mean, generally, one would say that that is potentially what US policymakers are doing with 0% interest rates and no indication that we're going to see interest rates rising in the US. So surely other economies are going to start responding to other countries holding their currencies artificially low. That's really, I just wanted to elaborate on the question.
Possibly, but I think the world currency markets are driven to quite an extent by the traders. The massive amount that is traded every day by foreign exchange traders, not by governments of countries. And governments have tried many times to affect their currency, and the only one that had any success in the last many years, I think, is the Swiss government, Swiss central bank, that managed to peg its currency. But all the rest.
Now the head of the Swiss National Bank has had to resign because his wife was trading on potentially inside information, alleged insider information. Just thought I'd throw that in there.
Yeah.
On the currency front, do you think, again, I'm making much of nothing about potential currency wars?
Well, I think we're already starting to see it. It's more indirect, and I think we're going to continue to see it. It's in this environment, government policymakers will attempt to do whatever they can to try and support their
to stimulate
domestic
growth
interests.
internally.
The point, though, is that it's normally quite an expensive adventure and not always successful or significant. The only country in the world that can really manipulate its currency with ease is, well, there's a few, but it's the United States, and that's because they have the reserve currency of the world. What the Fed wants to do, they can almost achieve. And there was a lot of accusations with quantitative easing 1 and 2 that that was the indirect policy purpose to devalue the dollar. Perhaps it is, and you know, they'll act in according to their mandate, which is to increase employment. And if they think a weaker dollar will achieve that, they'll intervene.
And of course, it's a debate for another day as to whether the US dollar deserves to be the reserve currency of choice in the world. Paul, let's move on from here. And global versus local equities, your thoughts on that front?
Stanlib does also believe, along with almost every other fund manager in this country, that offshore is offering better value. It's trading where it was 11, 12 years ago on average. Japanese where they were, I think maybe 20 years ago, more, 30 years ago. So still down, I think 75% from their record high in 1999. So on the face of it, it certainly looks better value offshore.
But where offshore? Let's be a little bit more specific. Big place offshore.
The outperformer in the last year, very, very, very dramatically so, was the US stock market, with the help of a stronger dollar too. But, you know, and at the moment one would say, look, the best value is in Europe because of the problem. So you're getting 4.5% dividend yield, and, you know, you're trading at about 9 times earnings. So the German stock market took a huge knock last year, 30%, and yet the economy is actually quite good. It grew 3% last year, as we heard today. So, you know, there's very good value in Germany, I think, and in other European shares. There's excellent value still in some American shares, and Japanese, you know, across the board. But I wouldn't write off our market. I mean, our market has been remarkably resilient, and it's got an interesting makeup. You know, SA Breweries and other international shares that trade on the JSE are quite big in the
that
indices.
have emerging market exposure. Would that be one of the key criteria for you?
Definitely.
Thoughts on local versus global? Do you have any thoughts on that front?
Well, we primarily focus on local, but we obviously do look at international companies just for relative comparisons and valuations. I agree the US is looking fairly cheap, and the German DAX is also looking cheap. However, we think that, you know, the interesting thing you bring up SAB, we have, as South Africa, for the size of our economy, versus the size of our market capitalization, we have some incredible international companies that derive the majority of their earnings offshore, and you can participate in that. So there are some South African counters that we think look attractive and will benefit from offshore exposure. We're African specialists, so we have a good focus on African markets, and we think there's compelling value in a number of those African markets if you are prepared to go with the liquidity constraints that exist there.
And
resources
took a big knock last year, and we're very resource heavy, so we have good bounce back potential.
And
also.
you bring me exactly to my next line of questioning. We've been discussing China on this desk extensively
My
this
China.
week. China, Asia, your China. And we're looking to the 17th of January. We're expecting GDP, fourth quarter GDP numbers in China to come out at 8.7%, slightly below the 9.1% for the third quarter. Martin Davis, Frontier Advisory, last night, very bullish on the China scenario, saying that journalists make far too much noise about any negative data points in China and that you've got to look at what is happening on the ground. And it's really an animal that cannot be held back. Similar sentiments expressed by Mark Ingham from Ingham Analytics. And of course, the question comes to what bearing that has on commodities, where we're going from here, which I assume you're bullish on.
Yes, look, they were all down 20 to 30% last year in dollars, and you know, it's well known, well, I think it's quite well known that the third year of a bull market, and we're still in a bull market, and I know you agree on that too.
At least.
You're not allowed to ask me the questions. When did you get to ask me questions? It's not happening on this day.
No, I'm assuming, and I'm seeing you nodding.
You're assuming. I was nodding, politely listening to your question. Anyway, go
So
ahead.
the third year of a bull market in commodities, in equities, known to be a difficult year, and it certainly was last year. I mean, you know, copper down close to 30%. The fourth year is known to be quite a good year, and I think we were shaping up for that. You know, you saw the data on China buying so much more of copper in December. I think it was a record month or something than they did in November. Okay, it's only 1 month, but at the same time, you know, the way things are looking, I think that can be quite bullish on commodities. Look, even with a strong dollar. And that's with a very strong dollar, which has usually been bad for those commodity prices. We've seen gold pop up, platinum pop up sweetly, what, $80 in the last week, despite the dollar getting stronger. So what's behind that?
And just to viewers out there, have yet to have Paul Hansen say to me that there is a bad year out there. They're all good. I would like to live in your world, I must say. From your perspective, just before we close out on our discussion with Paul.
On China and commodities, I get a little nervous when people say that it's an animal that can't be tamed. They said
actually, that wasn't any of their, that was my taking my interpretation. So again, maybe that was journalistic license and I've gone a bit wild on it.
This is how rumors start in the market. But I do get
I'll
nervous.
try and hold myself back.
I do get nervous when there's that kind of unfettered bullishness on any area, and it just reminds me of Japan in the late 80s, and there's a lot of comparisons that you can make between China and Japan. However, I do like to look at valuations, and commodities had a poor year last year after the QE2 stimulus faded, and sectors like the platinum sector really struggled. I still think Americans and Chinese people are going to be buying cars, and that will have good demand for platinum catalysts. And I do think the valuations on companies like Anglo American and BHP Billiton are not demanding, and you are paid to take some exposure there. And I like to be paid to go places.